Top of mind is the Fed. The Fed has released its June meeting minutes, and those minutes weigh on economic activity, on hiring, on inflation as well. At the same time, it's a disappointing set of data coming in from the U.S. Bureau of Labor Statistics. The U.S. non-farm payrolls for the month of June have risen by 209,000. The estimate was 230,000. Also, May's increase of 339,000 has gotten revised lower to 306,000. It does indicate a resilient labor market. How is the Fed going to move? What are the chances they will go up with their interest rates? And what are the chances they won't be as aggressive as they were last year? Let's discuss this. Geoff Dennis is our independent emerging markets commentator, joining us on the show again, along with Jan Lambregts, the global head of the financial markets research at Rabobank. Great to have you both with us, gentlemen. Jan, coming to you first. Now, 5 to 5.25%. That's the target federal funds rate. That's where it's sitting now, which means it is at its highest level since September 2007. And the Fed has this long-term inflation goal of 2%. So from this point onwards, how aggressively do you see them going after inflation control with the kind of macro data, especially on the jobs front, that they're working with?
Go much further than that. They need to get Powell on board, really. He's the more moderate voice here so far. That carried today last time around in terms of a pause, although they haven't referred to it as a pause. They'll have to win him over. But the data has been reasonably good, like we said here, and that, of course, raises the risk that they'll have to go further than just 25 basis points.
It seems so, Jan, but Geoff, are we getting a clearer picture of the kind of recession that the US would have, how deep, how prolonged it possibly could be? Because all this talk about interest rate hikes is coming on the back of growth fears.
Yes, indeed it is. But as has been widely discussed in the media recently and in the markets, this is the recession that never seems to show up. And so I think people keep pushing back their recession forecasts, further into the future. It's 6 months ahead. It's always 6 months ahead. It hasn't quite happened. And I'm not sure it will happen. I've always argued right from the word go that if there were to be a recession, it will be a pretty mild recession. But certainly, as your previous speaker said, there's nothing particular here except relative to the June labor market expectations to indicate that anything is slowing down dramatically. This is still a reasonably solid economy. Now, so I remain. It's not clear to me that we're going to get a recession at all. And if we do, as I say, it's going to be mild, and this data really doesn't alter that outlook.
Then in the current scenario, Jan, looking at how Wall Street is reacting to the minutes of the Fed's meeting, how do you see the impact playing out on rate sensitives, especially the crucial housing market?
So it has been moving on. Now, the key question to me is, where does this suddenly turn on a cusp, right? That's when you suddenly go into a recession. We had, of course, credit conditions tightening earlier on the year with some of the regional banks in trouble, but they have eased up since. So I'm not so sure how much that job is being done for the Fed now. And I think that's part of, what they're looking at. They're also looking at the government, because the government is still spending quite a bit. This is a theme across the globe. Governments are tasking their central bankers to be tough and to take the political fire and fight inflation, but they aren't really cutting their spending in commensurate ways. And that means central bankers ultimately have to do as much. The problem for the Fed's very simple. They've made some headways here. They have to assess how quickly that will impact, but they're still staring at inflation of 4%. And probably next week we'll see it fall to sort of the low 3%, but still, that's still too high, the 1-2%. So they have to figure out how much they still want to do. And one mistake we shouldn't make is that they're scared of a recession. They're trying to create one. They just want it to be mild or slow down wherever you want it. But what's happening? Is it happening at a fast enough pace? And to the extent it is happening, it's what they want to see. So, they're sort of breaking it, and it's baked in the cake.
Certainly seems that way. But Jan, this entire problem that we have been trying to address about the resilience of the jobs market in the US, you are indicating, and perhaps Geoff can weigh in on this, about the governments across, not just in the US, but across the world, where they have been going on spending. Is that the reason why there is this confounding resilience as far as the jobs market is concerned? Geoff, what do you think?
I certainly think it's an important factor. Fiscal policy has been expansionary in so many countries around the world. obviously initially, well, it was expansionary before COVID, but obviously there's a lot of COVID money put into the economies. And you've seen a general expansion of fiscal policy absolutely everywhere. And I agree with Jan that this has been a major factor, remains a major factor as to why you're not seeing the US economy slip into recession as quickly, perhaps, as anticipated. At the same time, I think there seems to be a degree less of interest sensitivity in the US economy to higher rates. First of all, consumers built up a huge pool of savings during the COVID pandemic, not all of which have been spent by any means. Fewer and fewer people are on floating rate mortgages. That's true in the US. That's also true in Europe and in the UK. Mortgage rates in the US have just gone to a new high for this cycle of over 7.2%, but you're not getting the dramatic collapse of the housing market that so many people predicted 6 to 9 months ago. I didn't think it would happen because you're not getting enough inventory on coming onto the market. So I think the fiscal side's played a very big role here in supporting the economy. And this is why I agree with Jan that basically nothing about this payroll report today, although it was perhaps a pleasant surprise by being lower than expectations, nothing's going to stop them raising to the end of July and probably one more after that. And then they're going to assess it. Inflation is going to fall to 3% next month because the comps are so easy compared to a year ago. But that's probably going to be it. And I wouldn't be at all surprised to see inflation a tad higher than 3% by the end of the year because the second half comps are much, much more challenging. So the Fed is not done, but they're going to watch this economy very carefully. And this, I think, was a bit of a welcome piece of news for them in that there's some signs in this report that some of the heat is coming out of the labor market.
So judging by the kind of pace and the size of these rate hikes that are to come from the US by the Fed, Jan, how are they likely to impact markets, especially the kind in India right now? We have been talking about these markets reaching historic highs. I don't know if you've been tracking what the Nifty and the Sensex have been doing, but we've seen them rise and quite dramatically at that. Now, if we see these rate hikes come in from the US, how do you think the Indian markets are going to react for one?
I think the main danger for emerging markets in general and India also specifically there remains that ultimately the Fed is setting policy based almost entirely on domestic considerations. If they have to go more because inflation simply isn't brought quickly under control, then they will do so for domestic considerations, meaning the bill for that, higher dollar rates has to be paid somewhere else in the world. And at some point you'll see the cracks appear. I don't think India is particularly in the firing line for this one. There are other emerging markets that are much quicker in trouble, but that trouble is kind of brewing. And it perhaps links up with another theme, which is if you think of the main battle, it's basically fighting inflation in the real economy with interest rates, a very blunt instrument. Superimposed on that real economy is a financialized economy. And that's where the first cracks has appeared. And whether that's in crypto or crypto platforms going bust, worries about commercial real estate, or in the UK not being able to do a budgetless trust and the pension funds that got into trouble. We've seen things come up, and obviously the regional banking crisis in the US was part of that. And it's very unpredictable whether we'll see some of that come up in the upcoming months. And that's where one or two interest rates hikes may not seem a lot, but they do, of course, raise the risk that in that financialized part of the economy, you suddenly have those cracks expanding and suddenly you do get a downturn there. And that would also affect emerging markets.
Geoff, you watch the emerging markets very carefully. How do you think the Indian markets are going to react to further rate hikes?
I'm a bit more bullish than Jan, I think, because you've seen in the emerging markets in general such enormous interest rate cushions being built in by earlier and more dramatic tightening in places like Brazil, to a certain extent Mexico, a lot of Latin America, and indeed other countries. And so I think you're seeing the protection there for currencies, which have generally done quite well. The disappointment this year in emerging markets has been, frankly, that the solid performance of the dollar has meant you haven't had much flow into EM. Plus, of course, you've had a very, very disappointing performance by China. So there are sort of odd cross currents here in an up year for US equities. Within the emerging markets, I see India in pretty good shape, as Jan does by all accounts. Real interest rates are somewhere near zero. They may have to raise rates a little bit more. I think that more depends on domestic inflationary developments rather than what's going on in global markets. And if at the end of the day, which is what my view has been for a while, we haven't quite got there yet, that we are near or almost at the peak in Fed interest rates, is eventually the dollar will break lower because the current account deficit is so big in the US. And as that happens, as the dollar breaks lower, I think some of this optimism about emerging markets will come through, and you'll start to see some narrative of what has been a dramatic underperformance this year of almost 1,000 basis points, although China weakness has had a lot to do with that. So a little bit more optimistic because the interest rate cushions have been robust and also are robust, and also because I see the dollar going down over the 6 to 12 month horizon.
We will continue to watch the markets. Even right now, we are seeing some flattish moves come through on Wall Street, and we'll delve on that a little later. But Geoff and Jan, thank you very much for joining us with your perspective on what we should be expecting from the Fed, going by the kind of decisions that have been taken at the last Fed meeting and the minutes coming through as well.